I just think it's been totally underrated. I hadn't come across it before. And the share price has fallen post-IPO, like virtually every listing back in 2021. It's actually come back to the IPO price at £1, just about £1.35, £1.36. And what you get with this is a very nice dividend. It's very cash generative. Going back to Halma, it seems to be making acquisitions through internally generated cash flow, but also it pays a nice dividend, 8% dividend yield. But yeah, an AIM company that I'd never heard of, and probably most people haven't heard of either. Worth a look.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM, and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hello Lee, good as always. Exciting week again and some controversial topics to discuss, I think, on this occasion.
Yes, but this time the controversial topic is, I think, between you and I, isn't it?
Yeah, it could be an interesting one. Always good to have a balanced argument, shall we say.
It is. First of all, though, quick run through of what we're going to be discussing. Musk's pay deal. In the UK, we discuss a great company that few have probably heard of. That's Halma. They've just posted record revenue and profits. And then from the small cap world, we've got Cakebox, we've got Renew, RWS Holdings, Castings, and Public Policy Holding.
Yeah, that's really interesting. Really under the radar at the moment. Thought we'd give a little mention.
Yeah. First of all, we've got some good news for the London Stock Exchange. We've got an IPO in London. Hooray!
Yeah, there was much rejoicing on this. Raspberry Pi, a low-cost computer maker, Cambridge-based, unusual sort of structure of business. Most of it's owned by the Raspberry Pi Foundation, which goes to support interest in computer sciences, computer programming, and it's really nifty. I'd implore people to look on the website. But yeah, it floated at £2.80. And as we speak, it's at £4.12p. The market capitalization is just shy of 800 million. So great news for London for attracting this IPO, and it's profitable. Revenues are up 40% last year to $266 million. It makes a bit of money at $38 million pre-tax profit. It has said, though, that business this year is a bit slower and it might be more second half weighted. But yeah, great news for Raspberry Pi, and London needed a float. Could this be the start of other companies floating? And it looks an interesting little business. You know, I don't know too much about it. It designs and develops low-cost single-board computers for industrial customers, enthusiasts, educators. It's tried to put them in a lot of the schools, but most of its business is coming through industrial embedded market. That accounts for 70% of its revenue. And these embedded applications go into things like electric vehicle charging, elevators, escalators, moving walkways, industrial controls and automation. So yeah, it's an interesting offering, and we wish it well. I hope it goes well.
Yeah, agreed. And they've got some pretty big backers, haven't they? The big shareholders are Sony and ARM as well.
Yeah, they have. They got Sony. I think their products are generally manufactured by Sony. But yeah, ARM, again, another Cambridge-based business, is a big shareholder, 8%, I think, circa they own. Yeah, good news. I mean, we needed a new company on the stock market, and London's got a technology business. And actually, I think the valuation, 800 million, it looks pretty punchy now, given what they've delivered, and growth outlook isn't stratospheric. People that said you don't get a fair punchy valuation on London, this is proving not to be the case, probably for the time being, at least with Raspberry Pi.
Absolutely. Best of luck. And moving on to Tesla, Musk's pay deal. What's your thoughts on that, Chris? 56 billion. Is Elon Musk worth it?
Yeah, he's been downgraded a bit lately, hasn't it? 46 now, but 46? What was 10 billion amongst friends?
Well, that would have paid for Twitter.
Yeah. I think that might be part of the issue here. So this pay package is all based on a deal that was hatched in 2018 to reward Musk for his efforts to drive the growth in Tesla. Tesla was basically on its knees in 2018. It was virtually going bust. It needed more money, and they put this incentivization plan in favor of the deal, and it was voted through by the board of directors at Tesla. From my perspective, the argument isn't about the deal. It was the nature of it. And that's what the judge, in connection with this case, has been considering. Tesla shareholders voted in favor of this incredible pay package in 2018. But they're saying that shareholders weren't fully informed. Those shareholders also weren't really informed of how beholden many of the directors were to Musk and how this affected the compensation negotiations.
Just for the audience, in case they're not aware of it, what was the pay package?
It gave him stock options over around 1% of Tesla's equity each time the company achieved certain milestones, operational and financial goals. And some shareholders argue that shareholders in a register were not told how easily the goals would be achieved when they voted on the package. I mean, I agree, that's a bit sort of in hindsight, because as I say, at that point, Tesla was not in great financial shape. And what they've subsequently achieved is quite incredible. I find it somewhat trite as well that a board member saying that reinstating the pay package was necessary for, quote, retaining Elon's attention and motivating him. Quite frankly, Elon had 20+% of the business back then, or even more. So there's ample, surely, incentive if you're a huge shareholder. At least that's been the case with every other company I come across. When management insiders have huge equity stakes, you don't necessarily see them, well, I haven't seen any of them having these sort of pay deals. A lot of the time, these incentivization pieces are put in place for outside managers coming in, who actually haven't got big equity stakes in a business. One company, by example, that relates to is Persimmon, the builder. They put huge incentives in place for the former CEO at a time when Persimmon's share price was at its low. Subsequently, it benefited from a rebound in the house building sector, and everybody was up in arms then because this guy was receiving, I don't know what it was, 100 million or something. Well, he subsequently, I think, had to give some of it back or agreed to give a heap to charity, and there was much hullabaloo. Imagine if they'd have been faced with this one.
Yeah,
50
that was 100 million.
Yeah. Several big shareholders are really anti this. CalPERS, which is a huge California state pension fund, $500 billion pension fund, they complained back in 2018. And another minority shareholder who held very few shares complained as well. So it's less the fact, the value of it, the quantum of it, and more the way it's been dealt with, I think, that's not right.
Yeah, it's the judge's kind of judgments, isn't it, that the directors were beholden to him in 2018. The directors haven't come out and said that, have the judge's assessment of the case in Delaware? He said, or so she said, that the directors were beholden to Elon Musk. I guess only if the directors come out themselves and say, yes, we felt under pressure from Elon. Could we confirm or deny that, do you think?
Yeah, I mean, there is that argument. They're not going to say that, and clearly they can do.
No,
they're doing
I wouldn't have thought
They're
they
doing
would.
nicely.
Yeah,
They're
they've done
doing
well.
nicely out of Tesla as well. The irony of it is, it went to appeal, and now Tesla hasn't even waited for that. It's gone and sought a vote again among shareholders, which is imminent as we speak. It's due out shortly, the vote.
It's looking like they're going to win as well, isn't it?
Yeah, it looks like he's going to win, despite several big shareholders not backing it. However, even if he wins, it could still go back to the judge, could still decide to go to review. It's not the end of the story. I do find it all a bit obscene, really. And I sense that Musk is a bit upset that they're effectively reneging on a deal. But then again, the deal looked somewhat questionable in the first place, at least the approval of it.
Yeah.
But then to come back and really say, I need to own 25% of this business to be fully incentivized, is just quite really ludicrous. And how much money does any single person need? And surely there's incentivization enough. And what I find very different with this is, and which contrasts with the typical management that I invest with, is Musk has countless other interests. If this was any other person with this number of interests, I think the board would have balked and said, no, hold it, we'll give you this deal, but you've got to focus on Tesla here. We don't want you swanning off and dealing with a rocket company, because that might impact your efforts towards growing Tesla. And this is the thing, this chap's got countless other interests. He'll argue they will benefit each other, but surely that's not entirely correct. And that, to me, looks very unusual.
Yeah, it's worth pointing out as well, part of the pay deal was he agreed to take no pay as well, wasn't it, from 2018? He won't take any pay, and providing the company 10x, then that's when he would get his pay deal, isn't it?
Yeah, and he has to hold that even if he exercises the options and takes up the stock, he has to then subsequently hold the shares for 5 years before selling them. So conceivably in that time, if Tesla's share price drops a lot, the deal's going to be nothing like the ultimate value, will be nothing like this. It could subsequently fall. Other people's, isn't it? There are a lot of companies where management doesn't receive a remuneration. The much as I say maligned Mike Ashley of Frasers, aka Sports Direct, or much maligned by Newcastle United supporters anyway, he doesn't receive any pay. I don't think Mark Zuckerberg at Meta, Facebook, receives any pay either. Warren Buffett receives only $100,000 a year, and that's it. Charlie Munger was the same, which probably isn't a lot. And Warren was pretty well aligned. He's pretty well aligned. He's got a huge stake in Berkshire Hathaway as well.
Here's a question for you then. If one of the founders of one of the companies that you're invested in came to yourself and many other of the shareholders and said, so I won't take any pay, and all I ask is that if I 10x the company in the next X number of years, I get 10% of the value of the company. Would you vote for that or vote against it?
Off the top of my head, 10 times the value of the share price over a couple of years. I'd like to see a longer term arrangement. So, for example, in the case of Musk, yes, fine, you can be granted shares. I'd like to, the devil will be in the details, shall we say? Because there's one thing, 10 times, how is that going to happen? And how long subsequently is that person going to be tied in will be absolutely key to me. I hate to see people cashing out on a relatively short term deal. And for example, a 5-year incentivization plan is quite short term. If I'm going to be stuck or my client's going to be stuck holding the stock for 10, 20 years, whatever it is, clearly I have the choice to get out. But I would like everything to be very much based around the long term.
Shall I share what Todd Moran has said? He was Todd Moran. He was the general counsel and corporate secretary of Tesla, of the board of directors from 2013 to January 2019. And he's put a lengthy post on Twitter. Vote on the pay package for Elon Musk should be a landslide in favor. There's a long list of things I was incredibly proud of to work during my years at Tesla, and the pay package is at the top. It was the most shareholder-friendly pay package ever conceived, no pay of any kind unless shareholders did better than anyone thought possible, and Elon should be celebrated for having signed up. The thought that any investor would have pocketed the tremendous upside over the past 6 years and not honor this deal now, after Elon moved mountains to make this upside happen, is unfathomable. I had the front row seat of Elon's incredible sacrifice, the pain that he quietly endured under his brilliant leadership and decision making. He led from the front, inspired everyone else at Tesla to achieve the most didn't realize was possible, and the world changed for the better as a result. So I know it's a bit of a speech there, but Bill Ackman as well commented on that. Bill Ackman, I'm sure many have heard of Bill Ackman on this podcast. I'm not a Tesla shareholder, but I couldn't agree more. Taking away Elon Musk's compensation after he created enormous value for shareholders is theft, and stealing from a CEO who has created spectacular value for shareholders is not a smart long-term decision for the company.
Bill Ackman is a hedge fund manager who also benefits from very large incentive-based remuneration, but typically around performance, which can actually be quite short-term as well.
He's quite I know he's quite a short-term.
I find, to summarize, there's a lot here about one person miraculously transforming a huge car manufacturing business. How about sharing all these riches out across the entire workforce a little bit more, to have, in a nutshell, such a huge package centered on one person who may have slept on the factory floor, but who may also have shouted a lot at everybody else.
I think he did.
Seems a bit rich to me as well.
Yeah.
I think it's a classic case of where also the creator alienates himself or herself from the rest of the workforce. That's the risk here. Is this going to alienate the rest of the workforce, which could ultimately compromise the performance of the company? But this should all be shared out, since it's absolutely bonkers. What's anybody going to do with all this? Even if the deal is correct, which I think fair enough, if they agree to it, they shouldn't renege, but it's absolutely ludicrous, and the sums involved.
I do completely agree. I know the 56 billion is, 46 now, did we say at the start? It's an obscene amount of money. It really is. It's incredible. But yeah, I guess from my point is the deal was made, wasn't it? So the deal was made. But I guess
if the deal was correctly made,
if the deal was correctly
on a
made,
correctly formulated deal.
Agreed. Yeah, so that's where I fall on that side. But I agree with you. 46 billion. Wow. And fair point. What will the workforce say? What will the Tesla employees say? They say, hang on a minute, he didn't build this on his own. Where's our share? And
exactly.
Yeah, quite rightly too as well. So can we move on anyway? That was
yep.
That was a long back and forth.
It's been very much in the headlines though, so I think people need to appreciate it, and that is a high profile business.
Would you be buying Tesla anytime soon, Chris?
We put out an article that the shares look good value. I'm still not convinced. This is our technology guru. I just wonder if the rest of the world's starting to catch up. I know we have the autonomous driving with the robotics piece, but as a vehicle car company, I think electric vehicle company and all the data bits as well, I think other businesses may be catching up on this now.
Yeah, on the fence still then for this one, for the time being.
Absolutely, I am. Unfortunately, I'm not a good judge of the valuation of this business.
Yeah, fair enough. But one that you are invested in at fundamental,
Yep.
as well as in the IC portfolio, is Apple, isn't it?
Yeah, and Apple's once again risen to the top of the pile, the world's most valuable company. This was after it announced that it had partnered with OpenAI to integrate ChatGPT into its devices. It's the next big step, will be driven by generative artificial intelligence. Of course, Apple has cheekily called this Apple Intelligence AI. It could be very exciting. And generally with Apple, they do things well. They think about things very carefully, and they're going to put a lot of power into your iPhone, which obviously clearly picks up a lot of data anyway. And so it's quite an interesting move. And this has really propelled Apple's share price, which had been falling a bit, to back up to all-time high of $215 a share. Fantastic.
What do you think as well about ChatGPT partnering with Apple, but actually ChatGPT is partly owned by Microsoft?
Yeah, effectively by OpenAI. But people forget as well, years ago, Microsoft almost bailed out Apple when it was on its. Microsoft made a big investment in Apple. Should have held on to it. Would have done even better. But yeah, there was this, despite the early rivalry, and indeed probably the ongoing rival, which is less so now. Both Jobs and clearly has passed, and Gates is no longer involved in the business. So I don't think there's that personality rivalry anymore. But yeah, I think it is interesting that they're coming together a bit more now.
Well, shall we leave the international stuff there then, and we'll move a little bit closer to home, starting with a company that many have probably never heard of, and that's Halma. They've just reported record revenue and record profit, and it's a business that you like the look of, isn't it, Chris?
I think this is a great example of business, as you indicate. Few people would have heard of Halma. It's a collection of businesses providing technology solutions in safety, health, and environmental markets. A lot of testing equipment. Employs over 8,000 people around the world, but few will have heard of it. It's an it's just shy of £10 billion company now. It's got this safety, environment, health sort of divisions. It was founded in 1972 by a guy called David Barber and another chap called Mike Arthur. It's worth reading David's letter. If you go on the Halma website, read his letter, and their focus on long-term shareholder value, that focus on the long term, which few people look into now. And one comment I thought was really interesting. Of all the meetings he has with investment managers and analysts, nearly all of them, he didn't remember anyone talking about the long term to them would have been current year earnings or historical results. Very few were interested in what might be going on 5 years out. So that's what they're running the business for, as a long-term investors, the long-term shareholders. Yet nobody they spoke to ever really questioned that or dug into the longer-term strategy. All they were interested in was the short term. Anyway, in the short term at the moment, Halma's doing very well. Organic revenue is up 8% to a record just over 2 billion. Underlying operating profit up 12%. Nice margin of 21% to 424 million. And this has been a so-called buy and build strategy. So they mention organic growth, but that also includes Halma's acquisitions. And Halma makes acquisitions from internally generated cash flow. It doesn't go back to shareholders and say, we want more money. It's buying things from its own internally generated cash flow. And that's something that David Barber also emphasized, which is great. And I look at a lot of companies on AIM, and there are very few of AIM companies like that. So I think I can name one, Gamma Communications, which has grown a lot through internally generated cash flow. But a lot of AIM companies keep having to come back to the well to their shareholders for more money and capital to grow, the so-called buy and build strategies. Halma has done this over a long term, doing it all itself. It's had 45th consecutive year of dividend growth. The dividend yield's tiny, but it's been growing incredibly over the years, and a terrific cash generator. The shares haven't looked cheap for ages. Now they're trading at 30 times forecast earnings, but ever there is a lesson here, is be prepared to pay up for quality. And this has been a really high quality business that's seemingly been also run by high quality management teams with a steadfast strategy that remains to this day. So well done, Halma. Absolutely brilliant. We need more companies like this.
Yeah, it is. It's a nice UK success story that, again, you just don't hear much about these sort of companies, do you? They're just not promoted in the way that perhaps they really should be.
And this one has been chugging along, delivering time and time again.
Yeah.
It's got huge international, I think the US is its biggest exposures to North America, US markets. But yeah, you don't hear much about it.
Yeah, when we discussed the week before's podcast on Takeover Mania, we mentioned, didn't we, that the London Stock Exchange, what could they do to help the London Stock Exchange? And they could promote these companies better, perhaps.
Yeah, this sort of business is worth being put on a pedestal. It's been such a great story.
Brilliant. So should we move down the ladder towards the UK small caps and AIM? And we've got Cakebox next.
Yeah, Cakebox Holdings seems to be doing really well. Cake shops are a bit of a sore point with me, having with the involvement with patisserie holdings. But Cakebox is it's a
So you're not an
franchise
investor.
operation.
You're not an investor then.
Not at the moment. I think it looks interesting. They had a bit of a hiccup a few years ago. The accounting left a bit to be desired, but they seem to have righted the ship, growing nicely, again, all organically from internally generated cash flow, all built around this franchise model of retailer fresh cream celebration cakes. And all of their products are 100% egg-free. The founders follow a strict lacto-vegetarian diet, and they came up with this idea. The first store was in 2008. Now they have got some 225 franchise stores. They opened 20 last year. Their objective is to get to 400 odd. That's going to take about another 9 years, I reckon, if you're doing 20 a year. I thought it was interesting. The sale of sponge is their biggest revenue line. So they're supplying sponge into their franchisees who are obliged to buy sponge and other product from them. The current market capitalization, they're only small, £72 million.
Do you mean sponge cake?
Yeah, basic sponge cake. So I assume then inside sponge cake, yeah. On the site, they assemble these things. But yeah, it's quite interesting. You get a nice dividend as well, 5.5% dividend yield. So worth looking at, I think. And easy to understand. There must be a cake box near you. If they've got 225 shops, I'm sure there's one not too far away. Go and visit them. See, buy a cake.
There's definitely not one in the little town where I live in the north of England, but I did look at the website, and I have to say, if the cakes look as nice as they do on the pictures, I could see me putting on a few pounds.
Maybe there's an opportunity in your area. Maybe they should be going there.
Yeah, absolutely. And the franchise model, straight away when you said that, franchise model, I was thinking of McDonald's, Continental Hotels. These are great.
Yeah, which we covered before, and great margins. Franchise, when you can franchise, when it works, fantastic. High returns on capital, because remember, all your franchisees are putting in the capital, really. They're just plugging into your system and way of doing things. So when it works, franchising is a great business model.
I'm sorry I interrupted you there where you're going through the financials as well. Did you touch on what the operating profit was and the free cash flow? I know these are two big things that you like to look at.
Yeah, so for its own business, the revenue rose 8.7% to 37.8 million. So that's just the money it's taking from effectively billing to franchisees. And from that, operating profit was 6.4. It rose 15%. That's a nice margin of circa 17%, healthy operating margin. And most of that flows through to cash. So you're getting terrific cash flow. I think free cash flow is sort of 5 million quid or something, or maybe a bit more. So you're getting a great cash generator, which they can then use to go on to support the growth.
I'm just thinking, so you're not an investor at the moment.
Yep.
You're still a little bit burnt from patisserie holdings. What would it take for you to become a buyer of Cakebox, and what would you like to see?
In summary, I've probably got two issues with this business. There are a few barriers to entry in this space. As I said before with patisserie holdings, you could say that about any restaurant, cake shop, coffee shop business. So there are a few barriers to entry. They've got to 225 sites. Their target is to 400 in the UK. Is that achievable? What is the market opportunity for cream cake, celebration cake shops? I don't know about that. Is it going to be harder for them to get the right sites? They've got this going at a time when nobody really wanted a high street presence, so I suspect their franchisees have benefited from quite decent rental deals. Can that be repeated now? So there are a few issues, but the growth bit is a concern. Let's see how they get on over the next 12 months. Perhaps there is a lot more to go for, but I'm not convinced. And in the meantime, the ghost of patisserie still hangs over this sector for me. It shouldn't do. This one did have a bit of an accounting hiccup a few years ago, which is also a bit of a red flag for me. It seems that it's sorted out, but
Yeah, it's interesting to hear your thoughts on what it would need to do to overcome.
but I do like franchise businesses, and
Yeah.
I like what this is trying to do. But is the cake shop there? Is it really expandable to the extent that these people are suggesting?
Is there a big enough market for the product that it's trying to sell,
Yeah.
which is
Yeah.
cakes?
Yeah.
Yeah, there's plenty of birthdays, and I've noticed on the website they're promoting Father's Day cakes today.
Yeah.
So they're trying to capture on whatever the current sort of trend is. There'll be Mother's Day, I'm sure, back in March. So we'll see what they're trying to do. But how many cakes can they sell? I can understand why the McDonald's works, because everyone
Yeah.
has burgers and fries multiple times a week. Some
And all sorts of other product you can put through there as well. Yeah, it's very different. I don't know. I'm not great in this sector. It's not a sector that I do feel for the real growth potential here.
And moving on to a company that you do think has growth potential, and a company that you hold in the fundamental asset portfolio, and that's Renew.
It is, yeah, it is. It's in our fundamental aim portfolio. Great business, steady performer, and engineering services group. I thought what was really interesting about the news from this week, a few weeks ago, we spoke about National Grid. No, last week we spoke about National Grid and their capital allocation. How are they going to spending huge amounts to upgrade the grid to support all the electrification going on? Renew has just made an acquisition, and the business it's acquired is going to be a beneficiary of National Grid's largesse, because it specializes in the provision of high voltage and extra high voltage infrastructure, which is just the sort of thing that National Grid is going to be needing to buy in. So here you go. This is where all of National Grid shareholders' money is going to be going, is to Renew subsidiary, which suits me just fine. Unlike National Grid, if you look at Renew, it's a very capital-light business. It doesn't need much capital. Huge returns on capital. So total opposite to National Grid. I thought this was somewhat ironic.
So the best companies to benefit from the electrification growth could be the companies that actually serve National Grid and not National Grid.
It's your classic picks and shovels. The gold prospectors who made it rich. They were the providers of picks and shovels, which could be the case here with Renew. And Renew hasn't just got this business; it's got all sorts of other engineering services supporting the rail sector, as well as supporting nuclear as well. So, yeah, good little deal, hopefully.
Yeah, and hopefully plenty more growth for Renew in some of the sectors there that you've just mentioned. But we're going to move on to a company now that the share price has took a bit of a beating lately. RWS Holdings. It's a company that, again, is in the fundamental asset portfolio. And it's a company that struggled because of what we discussed earlier in the podcast, which is AI, isn't it? It's really taken a beating due to the perception of how RWS Holdings is going to hold up in this AI world.
It is. We've held this for a long time, RWS Holdings. It's a language and patent translation business. It's really been battered, the share. The shares have really been battered. Growth slowed. Profitability's been pulled back lately. Still highly cash generative. You get a circa 7% dividend yield on this thing because nobody likes it. But this week it put out its interim results. The headline numbers weren't that great. It's all about the second half. However, what I thought I'd like to emphasize is it is highlighting its own AI credentials. Everybody thinks its business is at risk. The future of its business is at risk through AI, because that will all be plugged into language translation, will be AI generated.
We do it off our iPhone. We ChatGPT.
There you go. RWS is saying, look, don't forget us. We're ahead of this. We've been using AI for years, and we've got our own tools. We've invested a lot of money into it. Our clients, our technology clients, our life science clients, all our businesses, our clients need high quality translation, and we can help them do it quicker and a more cost effective fashion by using AI. And the results, which is littered with AI in their AI products, and the shares perked up a bit. They rose about 15%, which is positive.
Yeah. So do they operate more at the, shall we say, the professional end of language translation?
Yeah, very
contracts,
much so.
Things like that.
Yeah, they have localization service as well, a big localization business across their book. But yeah, this is very much B2B, high-end B2B, huge clients, Fortune 500 companies, yeah.
And is it the growth of AI that has had an impact on their share price and perception of the
perception? Clearly warranted in some areas. But they do seem to have been investing and being ahead of this. But yeah, it's just nobody like this share now, which is a pity because it was a real star performer on AIM for many years.
Yeah. Do you think they're ahead of the curve then at the moment? Do you think they can stay ahead of the curve of the AI?
I would like to think so, given the investment they've made and what we're starting to see come out of them now. It would appear that they're better placed than people thought, and we always thought that was the case. But yeah, the AI, this thing's moving so fast. Who knows where will get to?
Yeah. As you said, there's some of the large companies, the professional companies. I couldn't imagine them using ChatGPT on an Apple iPhone to convert their contracts. They're not going to just move from the services they use at the moment to using their iPhone, are they? You and I may, between friends and family, we may mess around with ChatGPT and ask it a few questions. But
Yeah.
these professional companies, they ain't just suddenly just going to go, oh, we can do it all on ChatGPT through our Apple phone now, are they? They're not going to transition like that, are they?
No, the
I
risk
wouldn't
of
have thought.
failure is high. The risk of a foul up is not great, is it?
Yeah.
The potential cost, sorry, of a foul up is not great. So I would say they need to ensure perfection, which isn't yet the case with AI. Well, it's getting there, but hopefully RWS will continue to do well out of this.
Is there plenty of articles on Investors Champion? Or?
Loads of information on all these companies, RWS in particular. Investors Champion has covered it, RWS at great length on many occasions. And it is a true world leader in its space. It's a real giant in its space that is apparently or currently sitting at low. So worth people taking a look at it. And you do get a nice dividend, and the dividend yield looks pretty assured given the strong cash flows.
Perfect. Should we move on to Castings then, which is a company that you like the reporting of Castings, don't you?
Yeah, this is an iron castings group, polar opposite end of the scale to anything
Absolutely.
technology related
Yeah.
or even renewables. This business has been around a long time. It's on the main market. It's not AIM. It does, as its name suggests, it produces castings, and it does it extremely well. And if anybody wants to read a lovely clean set of accounts, I would implore you to look at Castings, mercifully free of adjustments. Clearly, it's not making many acquisitions, so it doesn't have to adjust for those. Good, clear stuff. But it absolutely had a fabulous year. Turnover is up 11% to 224 million. Profit before tax increased 27% to 21 million. Both record results, mostly driven by price increases rather than because the weight of the goods they dispatched, the way it was actually marginally down. But yeah, it was doing fantastically, and shareholders are getting an extra dividend, a supplementary dividend, which brings the yield to around 7.2%, the dividend yield, historic dividend yield. You may question, this is a one-off, they're not going to be giving supplementary dividends, but I look back, and Castings has actually paid out a supplemental dividend in 5 of the last 10 years. So this isn't that unusual. Every other year, this business is going to reward its shareholders a bit more. If it's having a good time and cash flow is building, it's going to reward shareholders. It's said that the current year is looking a bit trickier because most of its customers are heavy truck customers. That's what it supplies most of its castings for, 80% of revenue. And having had a big spike in activity last year, it's going to be a bit more of a struggle in the current year. But it's cyclical. They'll bounce back again, and shareholders will no doubt get a very nice divvy again when it does. And I love it when companies are clean and don't waffle and come to the point. And look, it's not the most thrilling of sectors. I think it's the last casting business on the stock market. It's doing pretty well.
Brilliant. And should we finish off with a newer company to AIM, and that's Public Policy Holdings. They arrived in December 2021.
Yeah, I've never heard of this business. So I thought, and I looked at the recent updates, and it's quite interesting. And I'm actually due to be having a meeting with the management soon, which will be interesting to find out more. It's a government relations and public affairs group. It's a professional lobbyer, essentially. It was established in 2014, and up until now, all its operating companies were in the US, which was quite interesting. So it's listed on AIM, but actually, really, it's a US business. And it's got a portfolio of firms offering public affairs, crisis management, lobbying, advocacy services for trade associations as well. And it seems to be doing quite well. And it's just made its first UK acquisition. It's bought a business called Pagefield Communications, which is a London-based strategic communications and cross-party public affairs firm. It's paid £16 million for that. And I just think it's been totally underrated. I hadn't come across it before. And the share price has come back now, fallen post-IPO, like virtually every listing back in 2021. it's actually come back to the IPO price of £1, just about £1.35, £1.36. And what you get with this is a very nice dividend. It's very cash generative. Going back to Halma, it seems to be making acquisitions through internally generated cash flow, but also it pays a nice dividend, 8% dividend yield. But yeah, an AIM company that I'd never heard of, and probably most people haven't heard of either. Worth a look.
Brilliant. And as that's going to put us somewhere around about the half an hour mark, shall we leave it there? There's a few good companies for the audience to take a look at, or maybe not so much good companies, depending on how you view them.
And by the time people listening will hear what Elon's deal is.
Yeah, we'll have the results by the time you're listening to this. I'm sure you already know whether Elon's got his 46 billion or not. Thanks, Chris.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.